Good afternoon, everybody. I want to welcome you to the CSG eCademy webinar on rideshare companies, presented in partnership with the Griffith Insurance Education Foundation. My name is Sean Sloan. I'm the Director of Transportation and Infrastructure Policy at the Council of State Governments in Lexington, Kentucky. This is a follow-up to our first webinar, which took place back on June 23rd and introduced the insurance and regulatory issues involved with rideshare companies. Today, our focus is on rideshare legislation passed by states in 2015 and what issues may lie ahead for policymakers in 2016 and beyond. By our count, more than 40 states considered legislation this year aimed at either allowing or somehow regulating these companies. CSG has been excited to partner with the Griffith Foundation on this webinar and a series of other events to provide information to our members about what has become a key issue in many state capitals in recent years, the regulation of services like Uber and Lyft. To say more about the partnership, I want to call on Frank Tomasello, Program Director of the Griffith Foundation in Malvern, Pennsylvania. Frank? Frank, are you with us? Frank Tomasello, can you hear us?
Sean, thank you very much. The Griffith Insurance Education Foundation is pleased to collaborate with CSG this year. We are, in fact, delighted to provide state public policymakers with unbiased, nonpartisan educational programming on emerging risk management and insurance issues. In addition to our webinar series, we hosted two well-attended seminars in state capitals this summer. One on August 25th in Columbus, Ohio, and one on September 28th in Boston, Massachusetts. We want to thank the offices of Ohio State Representative Michael Stinziano and Massachusetts State Senator Tom McGee for hosting us and for allowing us to present these seminars to policymakers and staff as those states were in the midst of considering ride-sharing legislation. Let me now send it back to you, Sean, to introduce our speaker and get things started for the day.
Thanks, Frank. A quick note on how today's webinar will run and how you can participate. If you have a question for our speaker, you may type it into the GoToWebinar interface at any time. We will collect and collate those here in Lexington and ask as many as time allows. Well, for our webinar today, we want to welcome back as our speaker Dr. Kim Staking, an Assistant Professor of Finance at California State University in Sacramento. He received his doctorate from the University of Pennsylvania's Wharton School, an MBA at the University of California, Berkeley, and a bachelor's degree from Brigham Young University. He has nearly 3 decades of academic and practical experience, including having served in senior-level technical leadership positions at the Inter-American Development Bank. Dr. Staking is going to take us through some of the legislative activities we've seen this year on the rideshare front around the country and the issues and challenges policymakers may face in 2016 and beyond. Dr. Staking, the floor is yours.
Thank you very much. Am I online? Can you hear me?
Yes, we can hear you.
Okay, great. I'm thrilled to be back and talking with this group. I've been able to work with Griffith Foundation and the Council of State Governments in the initial presentation where we reviewed ride sharing. It's become a hot topic for legislatures, as well as participating in discussion with a couple of state legislatures and legislative assistants. And I've learned a lot in this process, and I'm really happy to be able to share that with you. Let's go to the next slide and one beyond that. When we look at the presentation, we're really focusing on legislation, and at the end I'll be talking a little bit about some of the insurance issues that are also involved in legislation. And so what we want to do is understand what the challenges for legislatures are. The sharing economy is very new. It's not well understood. Ride sharing in particular has been aggressively expanding across the United States and indeed across the world. Largely in absence of a regulatory framework. And it has really been pushes by regulators and others and legislatures to make the key decisions on how this should be structured. One of the things we'll discuss also is the challenges of coordinating insurance, the limitations of a personal automobile policy for somebody that's providing ride-sharing services. And I'd like to point out some of the changes we've had both on the legislative side and on the insurance side since my first presentation. We've had, as Sean mentioned, there are many states that have passed legislation, that have been considering legislation. We see some of the early states, California in particular, seems to be moving to a second generation legislation, so I'll provide information about how some of those have gone. Let's go to the next page. Just one more beyond that. Okay. So what the legislative issues are, the main one is determining whether ride-sharing is legal, whether it needs to be regulated. Legislatures need to concentrate on public safety. We're not just concerned with the interaction between the driver and the passenger and the ride-sharing company, but the wider public, pedestrians, other individuals that could be harmed or property being damaged by one of the drivers. And so the background checks of the drivers, the adequacy of insurance coverage becomes really important. I would add a second one of disclosure requirements, that I strongly believe that information needs to be disclosed to the regulators, to the insurance regulators in particular, the public utility regulators when they're the ones that are doing it, so that they can track what is happening. I believe that there needs to be some kind of better disclosure to insurance companies that may inadvertently be providing coverage for somebody that's doing ride sharing without knowing it. And then there's a critical right of the insurance companies that has been reaffirmed in many of the legislations, that they are not required to provide ride sharing under a standard coverage, and that they have the right to cancel or not renew insurance if they discover ride sharing activities. And in fact, they can deny coverage for somebody while they're engaged in ride sharing and send that liability back to the ride sharing companies. Can we move to the next slide? There's some other issues that legislatures have to consider when they're looking at how to deal with ride sharing and other aspects of the sharing economy. These are generators of employment. We talked in the last slide about how a driver is able to unlock the value of their asset, of their automobile, and turning it into a wage. This is done for people that do it part-time, college students, new employees that might do this, younger employees that might do this on the weekend, etc. But there is employment that is generated. At the same time, this creates a conflict with the existing transportation infrastructure, particularly the taxi industry. And so we need to be very aware of the trade-offs that we have between an emerging economy, an emerging network of providing these services, and our existing structure. As a legislature, I also think we need to be looking at the voter preferences. What do our citizens want to believe? And a critical one, particularly when we're talking with state legislatures, is the conflict between state rights and municipal rights. Historically, the regulation of transportation, particularly taxi transportation, has been left to the municipalities. In much of the legislation that's been passed, those municipal rights have been taken away, and so that there's a consistency statewide. And I know that some legislators are very concerned with that separation of rights. So let's go to the next slide that looks at public safety. And as I mentioned, we're really looking, when we're looking at the legality of public safety, and so, sorry, I think I had you go one slide too far. When we're looking at the legality, I think California's experience was very typical. I'm using California because ride-sharing started here. They're the first state that really addressed the issue. I believe that Colorado actually was the first state to pass legislation, but California addressed it very early. The first thing, ride-sharing came out, people started doing it. It wasn't very widespread, and it wasn't an issue for anyone until a ride-sharing car, while they were going searching for a pickup, lost control of their car and ran into a family killing a young child. It got everyone's attention, and at that point, ride-sharing was increasing in volume. The taxi industry was very upset. They were telling them this was illegal, and they went to the concerned parties went to the Public Utilities Commission, and ride-sharing services were declared illegal. Shortly thereafter, and this is within several weeks, the ride-sharing companies that provided more information to the Public Utility Commission, and they allowed them to operate, but set specific restrictions and insurance requirements, restrictions in terms of who can be driving, background checks, etc. Who could be licensed to do this, and this gave time for the insurance outlines to be developed, and those insurance guidelines were developed both by the Public Utility Commission and were highly influenced by the Department of Insurance. Dave Jones, the head of the Department of Insurance in California, wrote an extremely detailed paper that was outlining the risks, looking at some of the elements that the Public Utilities Commission had missed because they weren't insurance specialists. And those ended up being enshrined in legislation. And this was done in last year in 2014 towards the end of the year. Let's go to the next slide. One of the important considerations, again, public safety. How good are the background checks that they do? There have been incidents of personal attacks on passengers. There have been incidents of attacks by passengers on drivers. Are the problems with background checks more difficult or more problematic than those that exist in the taxi and other transportation industries? Both sides provided statistics about which one was better. The ride-sharing companies really have fought hard against requiring their drivers to be fingerprinted. They see that as an unnecessary delay, and because of their growth, they need to be bringing people on quickly. And in many cases, people start ride-sharing and they say, this is not for me, so there's a very high dropout rate after a couple of months. So they feel the importance of being able to continue generating employment and bringing people in. Other questions have been asked, and this is not really a public safety question, but a public fairness question. Is the premium being charged fair? It's generally lower than taxis, but at times when there's bad weather or very high demand, the ride-sharing companies will escalate their charges in order to attract more ride-share drivers to go to those locations where there's more demand. Again, asking how different are these from the taxi industry, where during periods of high demand, the cost is having to wait longer for a taxi to pick up. But these are critical issues that are being discussed with legislators. On the next slide, we talk about insurance adequacy. The initial position of the ride-sharing companies is this was no different than ride-sharing. The personal automobile policy should cover it. The insurance industry said, wait a minute, there is an exclusion against of providing what they refer to as livery services, the transportation of individuals for pay that is built into every personal automobile policy. It is not covered. And that was a message that the ride-sharing companies sort of didn't listen to. They were convinced that this was just like carpooling. But through the regulatory process, again, the insurance adequacy was driven by regulation and legislation. Is the coverage sufficient? Is the do we protect the passenger, the driver, and the general public? Is it possible to come up with a hybrid policy, or do we need to go to the more costly commercial policies? And then later questions have come out saying, what about the drivers? They have coverage that will cover their automobile if it's damaged while they're doing ride sharing, that will provide liability coverage, following the regulatory push standards and legislative push standards. But what about other insurance, disability insurance, unemployment insurance? Are they covered for workers' compensation? These are open questions. We'll come back to the insurance issues towards the latter part of this of the presentation, so I won't spend more time on it at this point. If you can go to the next slide. I want to introduce this term called disruptive innovation. It's a very technical term that's used by economists that are looking at a modern technological environment. It's a word that was created by Clayton Christensen when he was a professor at the Harvard Business School. And what it is this idea that the technology, ride-sharing technology, is creating employment for drivers, but it's disrupting the lives of others. We look at the owners of taxi companies, the owners of taxi medallions. Just for an example, if we looked at Boston, the average price for medallions sold in 2015, and I have an asterisk next to that because that is only in the first 6 months of 2015, dropped 40% from the 2014 price to 400,000. It was about 650,000. There's been a drop in the valuation. There are drivers that work for the taxi companies that are not picking up as much business. The taxi companies have cars that can go out and they don't have enough customers to fill them. So there's been a disruption in the employment of the taxi drivers. But at the same time, many of the taxi drivers have gone to work for the ride-sharing companies, believing that they're able to earn more money doing that. So the legislation needs to create a balance between these competing interests. If we go to the next slide. The other thing that I've discovered as we've been looking, that as I've been researching on the legislative issues, is this idea of knowing your audience. What are the passenger preferences? What are the voter preferences? When I was at one of the presentations from the legislators, the legislators that were there and sort of their chiefs of staff were very carefully considering the legislation. And when we got to the question and answer period, all of the younger staff used ride sharing exclusively for their transportation needs inside the city. It was quicker, it was cheaper, it was convenient, and many young people in particular, that we all see them living on their cell phones, they like the web experience. They like to know when a car is driving. They like to be able to identify the driver by the picture. They know that the driver's route is monitored and correctly priced. And some note that the rideshare cars are cleaner. This is one thing that people have also noticed, that with this, the taxis have been cleaned up. The taxi drivers are become a little bit more considerate. If we go on to the next slide, this is based on a survey that Lyft did of almost 6,000 passengers, almost 3,000 drivers. I want to note that this is focused on major cities. This is not focusing on small municipalities or the suburbs. This is in the major cities. 46% avoid owning a car. They see that a car costs about $9,000 a year to keep in one of the cities, including garage costs, insurance costs, the purchase price, the interest they pay, maintenance expenses. They're not going to spend that much in a year in ride sharing and renting a car if they want to go on a trip. 25% use Lyft to connect with public transportation because they don't live close to one of the metro stations. 45% say they spend more money at local businesses. They go out to restaurants more. They stay out longer. They stay out a little bit later, and that they feel that they can get home safely. And 54% saying it lets them get to places that are inaccessible. I'm imagining this is largely due to parking issues in those areas. Interestingly, as we go to the next slide, I just want to point out that in New York, ride sharing is allowed in New York City. It was turned down in the rest of the state in some legislation that was passed. There's been a lot of demand from some of the college towns to allow ride sharing services because college students need ways of getting home safe at night when they may have been drinking, and the designated driver also tends to drink, and so the ride sharing allows for that third party safe driver. I mentioned the issue at the beginning, the state's rights versus the municipal rights. It is very difficult for ride sharing to operate when there are different rules in every city that they come to, where there are different insurance requirements, there are different requirements about who needs to be regulated. I used to live in Maryland and worked in Washington, D.C., and Southern Maryland, Washington, D.C., and Northern Virginia were one large metropolitan community. Taxis go from one area to another. Usually they're not allowed to pick up a ride in D.C. unless they're a D.C. registered taxi, but you can pick up someplace else, drop off. From all states and the D.C. there are people that have pickup at the airport, etc. And there's really chaos if rules changed within a state. Cleveland versus Columbus, Ohio, we had the experience that Columbus really tightened the rules and Lyft withdrew, even though they were still providing service in Cleveland. Uber remained in both, but they were very concerned about the tightening legislation. They had fewer drivers there than they could have had. Looking at the other legislative listens are just, again, what I said. The disclosure requirements, in the next slide, please. The disclosure requirements, one more slide, please. The disclosure requirements to the insurance regulators, to the insurers, the right of insurers to deny coverage if they don't want to cover ride sharing, and then this sharing of data to allow insurers to adequately classify and price the risk. If I'm living in a suburb, I may have a much lower insurance premium than somebody that's living in the city. The insurance premium will be based on where I do most of my driving. I may commute into the city, but I generally commute in and commute back. I'm not driving around the city, and that's very different from somebody that's doing ride-sharing in the city but lives in the suburb. There have been, on the next slide, there have been some taxation issues, including excise taxes. Nevada added a 3% excise tax, not just to ride-sharing, but to taxis and limo services in general. They earmarked this for funding a medical school or completing the development of a medical school at one of the universities. Airport fees. These are paid by taxi drivers. Should they be paid by ride-sharing drivers? In California, we had the unfortunate experience that the ride-sharing driver or the ride-sharing companies were charging for these airport fees, but they never paid them to the airport authorities. The legislation issue, if we need to have commercial insurance provided by the ride-sharing company on all periods when ride-sharing is taking place, whether you have your app turned on and you're seeking for somebody versus whether you have, or you have a passenger in the car, or you have a connection where you're going over to pick up the passenger until you drop the passenger off. You keep the app on, is that commercial insurance still required? And this is not the presentation, go through the history. That was what we did in the first one, but we went from largely coverage under personal insurance to a situation where the ride-sharing companies were providing commercial insurance during the period that somebody is in the car, and very adequate commercial insurance for when the passenger is there or when somebody is going to pick up a passenger. But we still have that period where I'm searching for an app, where most of the ride-sharing companies consider that to be under the personal insurance company, and they will only provide coverage at a reduced level from what one might normally have and what they have in the other periods, only if your primary insurer denies your coverage. There's also the issue of authorized locations. In many of the states, there's been a compromise legislation where they allow ride-sharing, but they do not allow ride-sharing companies to pick up at the airport or other major transportation hubs. I read this article by Ken Warbeck, who's a lawyer that was at the University of Pennsylvania. He wrote a piece for the Wharton magazine in summer of 2018. If we can go to the next slide, we'll have his perspective. He says, the history of internet-based companies is to say we're doing something completely different, and that it is completely beyond the legal regimes. You know, we sort of work in this ether that's surrounding the economy. And this position very often fails, and for good reasons. And many of the companies that started out demanding these kind of protections ended up really being better protected when there's legislation from other companies that were starting up and doing some kind of copying, copycat service, etc. And Ken Warbeck's location, and this is pretty much a quote from him, an annotated, as a reduced quote, says that those companies that are focused on the sharing economy, the Internet of Things, and big data need to learn to work within the system, and that it is possible for them to do that. They just need to a little bit grow up and recognize how a corporation operates and how a corporation operates within the giving system. If we can go to the next slide. This is a slide that gives the status of ride-sharing programs across the U.S. It is a little bit dated. I believe it's from June or July of 2005. We know a few of the states that have do have it. I note at the bottom, Arizona, South Carolina, Louisiana, Colorado, the District of Columbia. Delaware is there not through legislation but some kind of regulation. New York is being visited. California and Colorado, interesting, were the first two companies that allowed ride-sharing and had ride-sharing legislation. California is shown on this graph as being passed by one of the chambers. It has now been passed in California, but it is a second-generation law. So we'll look at that a little bit different. If we can go to the next slide. It sort of provides some clarification that the personal automobile policy will not apply while you're logged into the ride-sharing services. This is unless you've purchased specific insurance that covers you for ride-sharing. The ride-sharing firms must provide primary third-party liability covering the cost of injury, death, and property damages to third-party companies from the time drivers start their app until they close them. There's a little bit in there, some language that deals with individuals that work for multiple rideshare companies, and they have them both on, or all three of them on, and they're waiting for which one calls first, and then they go with them. But that is something. There needs to be some kind of sharing. And then they also saying you need to maintain an extra $200,000 of excess liability in the case of a particularly gruesome liability. I think they're thinking of the pedestrian that is run over, the driver that attacks one of their passengers. So they're really going through this second generation, whereas much of the legislation that we're seeing is a very gentle regulation, allowing ride-sharing companies to continue with some of this contingent coverage. When we look at other sample legislation, if we go to the next page, Tennessee is what is regarded as the ideal outline for other states by the rideshare firms. It allows the rideshare firms to do their own background checks. It allows ride-sharing to exist statewide. It defines ride-sharing drivers as independent contractors. We'll get back to that issue a little bit later. Nevada, as I mentioned, placed a 3% excise tax on the fares to fund the medical school at the University of Nevada in Las Vegas. Utah put $1 million worth of liability insurance, higher than the liability insurance that's required on taxi companies in their country. They allow the firms to do their own background checks and vehicle legislation. That was also included in Tennessee. Skip one more forward. I'm looking at Maryland and Virginia, two states that are very close to each other and have similar legislation. In Maryland, it is it's a public service commission that regulates them, not the taxi cab commission. They'll issue licenses to companies, their drivers. They've sort of given the companies a 9-month waiver of using their own background check system without using fingerprinting all drivers to show that their system works as well as one without the fingerprint. And if that 9 months goes by and they haven't been able to show that, then they will require the fingerprinting. Virginia charges a $100,000 license to operate in the state. This is for the ride-sharing agency, not for each individual car. In their background checks, they've expanded it to require a history of felonies and a search of sex offenders and crimes against minors. Same $1 million liability, and establishing a zero tolerance policy for the use of alcohol and drugs. Somebody that's caught using that is done. Again, I have just another, on the next slide, I have a list of the states that have adopted legislation. I'm not sure this list is complete because there are changes that are taking place all the time. The California re-legislation happened just a month ago. There are other ones that have been very recent. So I'm not 100% certain that I've captured all of the states. There are fewer states here on my list than there are on what's being reported. And here's a list of companies that are still considering regulation. New York, as I mentioned, for statewide regulation. Ohio is in the legislative process. Texas is considering the legislation, and a lot of discussion of what's going there. Okay, on the next slide, I just want to talk about one of the most critical issues that exist. You can advance, there it is. This is the question of whether drivers are independent contractors or employees. The ride-sharing companies hire their drivers as independent contractors. They treat them as independent contractors. They pay them and give them a 1099 at the end of the year. As independent contractors, they're able to operate as businesses and subtract business expenses on their tax filings. But there has been legal challenge to whether they're really employees. The tax code is fairly complicated about what an independent contractor worth versus an employee is. One of the issues comes up is how much of the actions are directed by the ride-sharing companies. The ride-sharing companies are, when they pick up an app, they're directed to go pick them up. They're directed to go pick them up at a certain place. A certain charge is made for that. They don't have control of that charge. These are things that are in the gray area. One of the legal considerations is this work that's considered permanent, or is this considered part-time? I also want to note that workers' compensation is a sub-issue of that, and the legislators need to look very carefully at the workers' compensation statutes, because often the workers' compensation has different definitions for what is an independent contractor versus an employee. So that needs to be looked at. In California, the Labor Commission has ruled both ways. The most recent rules for plaintiff being an employee is subject to workers' compensation came out in favor of it. There's also an unemployment insurance appealed. They ruled that a driver was an employee because under the California law you have to be an employee to collect unemployment insurance. This was somebody that was injured and was unable to drive, and so they wanted to collect unemployment. And these two were administrative law procedures, so they are non-binding. This is not what would be going through a standard court, an appeals court, etc. This is just unique, but there are cases that are being contracted, if we'll go to the next slide, where in the federal courts, there's a class action suit that was brought in favor of drivers saying that they were employees and so they needed to be covered by workers' compensation. The rideshare companies had to pay for their 50% of their Social Security payments, etc. The ride-sharing companies asked the federal court to disqualify the class action, since they're saying each one of these is different. Some drive part-time, some drive full-time. They're in different locations, etc. The federal court allowed that suit to go forward as a class action, indicating that many of the arguments were convincing. There's a secondary issue that's been challenged in courts, and that's the one is the ride-sharing firm responsible for paying for maintenance, gas, depreciation, etc. That area seems to have less support among the judiciary. But again, I want to note, I am an economist that focuses on insurance issues. I am not a lawyer, and this is one where you really need to seek the professional advice of those individuals that know the details of the tax and the workers' compensation laws and maybe state laws regarding independent contractors versus employees. If we go to the next slide, this would probably be a good time for an open discussion. I know that you've been sending your questions into Sean, and I'd like to take a time to answer some of those questions.
Well, thanks, Dr. Staking, and just a quick reminder that if you do have a question for our speaker, you may type it into the GoToWebinar interface at any time, and we are collecting and collating those here in Lexington, and we'll ask as many as time allows over the course of or at the end of the program. But while we are doing that, maybe it might be a good time to have you respond to this, Dr. Staking. You had mentioned that you were talking about the sharing economy companies sort of trying to work within the system, and we've seen certainly a number of states and localities actually working very closely with Uber and Lyft to craft these policies, to regulate these companies, and the companies sort of seeming to be more willing to seek compromise with policymakers in some states. How do you see those sort of negotiations evolving? Have Uber and Lyft gotten better at getting what they want? Are states able to establish what they want? And are taxi companies being heard in these kinds of negotiations?
I would say, in large part, the ride-sharing companies are dominating in how the legislation is written. There have been some that have given restrictions for the taxi company that, this, as I mentioned, there are compromises where they can't pick up at the airports, but the legislation has, by and large, been favorable towards the ride-sharing companies. They have pushed the ride-sharing companies on the insurance side, and I think that has been very valuable. And as I'll talk in the next section, there are many more insurance companies that are beginning to develop hybrid policies that will cover some of these risks. But at least in terms of the legislation regarding legality, regarding their ability to do their own background checks, etc., they've been successful. The differences have been minor. The excise taxes, the licensing fee in Virginia was $100,000. I believe it was in Utah where it was a $5,000 charge. Different size economies, very different structures, but those kind of things have been different. But I'd say largely the ride-sharing companies are winning the legislative battle.
Mm-hmm. We have one question from a webinar attendee. They ask, have you heard any discussion about treating rideshare drivers just like livery service providers? And if so, how do they handle the independent contractor versus employee situation?
Okay, if you are providing a livery service, you are required to have commercial insurance. The cost of commercial insurance is 2 or 3 times the amount that a rideshare driver would be providing. And so that becomes very expensive, particularly since the majority of the rideshare drivers are not driving full-time. This slide will be provided to you. There's a slide in the back that gives some information about people that are driving full-time and part-time. I don't think it's worth going to that slide at this point, but there have been insurance companies that have dealt with that in different ways. Erie Insurance said, look, we have people that are delivering taxis. We don't require them to have commercial, that are delivering pizza. We don't require them to have a commercial license. We just require them to put on their application for insurance that they're using their car in commercial as a commercial vehicle. Very small difference in the price of insurance in that. Most states have not gone, or most insurance companies have not gone that direction, because there's a difference in liability in delivering pizzas than there is in delivering passengers. But there have been a number of insurance companies that have started providing that. Again, we'll cover in the next section by providing hybrid policies that sort of match the needs better. I'm not sure that commercial insurance is the answer. A taxi cab will have commercial insurance, but it will often be driven for 3 shifts, 2 to 3 shifts, depending on if you're in a small city versus a large city. And so it's more affordable to pay for the commercial insurance when it's divided among 3 drivers, where a rideshare vehicle is only linked to a single driver that may be working part-time.
And Dr. Staten, that might be a good time to transition to the next section on insurance. And again, if folks have any additional questions, they can type those into the GoToWebinar interface at any time, and we can try to get to those at the end of the broadcast. But we do have a lot to get to here in the next and limited time to do that. So,
yeah.
So please continue.
Thank you very much. And I will be going, if we go to the next slide, I will be talking about the insurance issues. I'll go very quickly through some of them. Again, I think there's a need for innovation among insurance companies. We need to have shared solutions. We need to come up with these hybrid policies that should be regulatory driven, rather than a legislator having to tell a ride-sharing company and an insurance company how to run their businesses. So far it's been regulatory driven because the two have not cooperated, but there is a gradual movement from the opposition to this limited opposition. And if you go to the next slide, listen to your actuaries. This happens to be a slide where the prices is going down, but you need to listen to your actuaries, and they need to get the data that they need to make these decisions. That's one of the reasons that I mentioned earlier, the importance of disclosure. Let's go to the next slide. Insurers and insurance contracts are written under the concept of utmost good faith. That this idea that there's a high degree of honesty imposed on all parties. The insurers strongly believe that the ride-sharing firms have been providing erroneous information, incorrect information to their drivers regarding what is covered under personal automobile policy. And the ride-sharing firms should have known, have been told. They know that this is the case, and they continue to do that. This is very upsetting. to the insurance companies. Also, ride-sharing activities are required under the contracts to be disclosed by the driver to the insurer. If they're doing anything out of the unusual, there are representations that they're making when they ask for a personal policy that they are, or if they have an accident, that they need to have the same utmost good faith in disclosing it. Go to the next slide. We also say that that markets can fail when the insureds do not disclose known risks. This is concealment. If I go get life insurance and I say, yeah, I'm very healthy, but 2 weeks ago my doctor said that heart murmur is looking really bad. We did a scan of it, and I think you're going to need surgery. That may be why you go out and try to buy life insurance and tell them that you're in great health. That's illegal under the contracts. It's concealment, and it's a reason that insurance, written into the policy, the policy can be canceled for that. And the ride-sharing insurance really creates a perverse incentive to the drivers to misrepresent when they have losses. If they're driving at a time when they don't have a passenger in the car and they get into an accident, at this point, most of them have personal automobile insurance, then they have the commercial insurance that's coming from the ride-sharing. They probably have the incentive to make that charge to their insurance company, concealing from them that they had their app on and they're looking for a rider, or they were traveling to a rider, because if they disclose that they were doing ride sharing, their insurance policy may be canceled. And there's a fear that if they go and tell the ride sharing company that they had that accident, that they will be canceled from being a ride share. So it's a really perverse incentive. Next slide, we're looking at how insurers underwrite risk. They gather data, they determine the risk classifications, they determine if something is a personal or a commercial risk, they try to predict frequency and severity, and they appraise the amount of time as well as the resources that are looking at risky activities. We go on to the next one. They're looking at the timing of loss payments. The longer-tailed lines will, they need to look at what the investment returns will be. And they'll come up with a determination based on actuarial rates, and they will add a charge for that to cover their expenses, to allow them to be profitable and pay dividends and grow. And underwriting activities are very difficult when the risky activities are different than they assume. Most people that have a ride-sharing, that have a personal automobile insurance policy, their car is parked most of the day. It's parked at home. Sometimes they drive to work or they drive back. They go shopping. They drive back. 95% of the time it is parked either at home or at work or at the shopping center or the library or the soccer field, sports field. And only 10% of the time are they actually driving the car. They drive it close to where they work. If they're commuting, it's a commute path they're used to that they know very well, and the determination of the premium is based on that. You have somebody that goes out and drives 8 hours a day, driving late at night, picking up people after they've been late in a bar or late in a restaurant, taking them to places that they don't really know well. They don't know the community. They don't know how safe it is, etc., is a very different risk class. As the questioner mentioned, the question, there is an exclusion for a number of items in the personal policy, including providing livery services. And the initial reaction of the insurance to ride-sharing was basically this is liveries policies, and they're excluded for good reasons. We go to the next one. The insurance industry works with Insurance Service Office come up with defined activities. Could you go to the next slide, please? There. One more. And they came out with a much more concrete definition of what providing livery services is, where they actually mention the transportation networks, the ride-sharing companies, is not covered whether or not a passenger is occupying a vehicle. Doesn't include to share the expense carpool, but it extends to the ride-sharing. If we go to the next slide, this is just a graphic that shows where the ride-sharing companies are providing the policy in the majority of the states. Somebody has the app turned off. They're driving around shopping. They're taking their kids to a ball game. They're driving to and from work. They are not looking for ride sharing. They say that is covered by your personal automobile policy. Then you go into driver mode. You turn your app on. And at that point, you create a contingent liability that they require you to first make that claim against your private insurance company. And if the private insurance, your personal auto insurance company turns that down, then they will come up with some kind of contingent coverage. This is one of the places where many of the states are doing legislation that they're requiring that contingent liability to become primary liability from the time that the application is turned on and at higher levels. Once the match has been notified to where the driver is linked with somebody, they're driving to pick them up, they pick them up, and to the time that they're dropped off, they're covered by a commercial automobile liability that's include uninsured motorists, underinsured motorists, up to $1 million. Contingent, comprehensive, and collision up to $500,000, excuse me, up to $50,000 to cover that. But many of the drivers don't realize that they have a $2,500 deductible for that. One of the ride-sharing companies has a lower deductible. And so it's really looking at that contingent period that most of the work is being done. I talked about the incentive for ride-sharing insurance before, so I won't repeat that. But I just want to talk about real quickly about the gaps in insurance. That's probably as much time as we'll have. For the passengers, the gap, their protection is generally equal to or better than taxi drivers. I think it was Nevada was requiring, it might have been Nevada or Utah, one of the states required the insurance companies to provide a minimum of $250,000. While the companies countrywide are providing that $1 million coverage. The drivers, will there be personal automobile policy when they're driving, when they're not driving? Will their policy be canceled? There's no workers' compensation. Drivers are their own for life, medical, and disability insurance. Let me stop there to answer any questions that we have and just invite you to, as you think about this, if you have any questions, send me an email. I'd be happy to answer questions offline as well.
And Dr. Staten, we are just about out of time here, but did you want to say anything here as we close about sort of the state of the insurance marketplace and whether you think additional companies are going to be offering ride-sharing insurance in the future?
Okay, if we go forward 2 slides, I have this slide and the next lists the companies that are currently providing automobile insurance. Again, each one has a slightly different structure. The cost of these hybrid policies are not very high. The issue is that these are provided in very few states. If we go one more slide, we have the states that are covered. One more, please. There are very few states where we have ride-sharing insurance. Very few companies that are providing it. There are more companies that are talking about it. As they go through these pilot programs, they're expanding to other states. But this is really a critical problem. That, and again, I think it's an issue of the legislative rules being very clear, so there's not confusion, and the ride-sharing companies sharing more information with the insurance companies that allows them to price this insurance. All of those states where that are in white, where there's no insurance coverage, ride-sharing is taking place.
Okay. Well, we are just about out of time for today's webinar. Dr. Sticking, thank you so much again for joining us this afternoon. Thanks also to Frank Tomasello from the Griffith Foundation. As with our previous webinar from June on this topic, this webinar will be archived and available on the CSG Knowledge Center and on the Griffith Foundation website. So if you missed any part of the program or would like to recommend it to a friend, it will be available soon. Be sure to check the CSG website for information about future eCademy webinars, and to check the Griffith Foundation website for information on risk management and insurance resources and programs as well. I'm Sean Sloan at CSG headquarters in Lexington. Enjoy the rest of your afternoon.